What I want to understand from you, maybe early days, maybe not, but about a month to go for the next Monetary Policy Committee meet. In fact, the first to be chaired by the new RBI Governor Sanjay Malhotra. Do you think there is a chance of the rate finally getting cut by at least 25 basis points? Some analysts, some experts do believe it is time. Before you answer that, just for our viewers, a cut in interest rates will mean that your fixed deposits are not going to fetch you the kind of returns that they have been fetching you so far, but cut in the interest rates will also mean that your loans become cheaper. So, Yuvika, let me take this to you. Any likelihood of a rate cut by the RBI next month?
So, looking at the downward rigidity in inflation for the months of November, December, and mind you, keeping in mind the global situation, especially the Fed sounding more hawkish in recent times, also we have seen a fairly brisk pace of rupee depreciation. And remember, rupee depreciation is also likely to have an impact on inflation. There is a certain component of imported inflation within the entire CPI basket. So, keeping in mind where we have seen the December print, even though we do expect January to see a meaningful correction in food price pressures, but the trend up till December, looking at the global situation, there is fair degree of uncertainty in terms of what will happen eventually when Trump comes to power. Tariff wars could, for all have induce inflation globally, and then there is likely to be an impact of rupee depreciation. Keeping all these factors in mind, we believe that the chances of a rate cut look more ripe for the subsequent policy after Feb, that is going into April. So that would be the next fiscal year. For Feb, we think that it would make more sense to stay pat on rates because there's a lot of global uncertainty, and also that RBI would want to wait for the January print to confirm the degree of disinflation that is likely to transpire in Q4. So
All
that is
right.
what we are thinking at this point in time. So
Right.
April
So,
more of a likelihood than Feb.
April more likely than Feb. Well, you mentioned the rupee. Just for our viewers, let's understand what is happening with the Indian rupee against the greenback. The Indian rupee took a massive hit on Monday, logging its steepest single-day fall in nearly 2 years. On Monday, it plunged by 58 paisa to hit a historic low of 86.62 against the US dollar. A stronger dollar and surging crude prices weighed heavily on the Indian currency. Now, what's more alarming is the fact that in the last 2 weeks alone, the rupee has tumbled over 1 rupee, dropping from 85.52 on December 30th. The relentless demand for the US dollar by investors is driving this plunge, coupled with a significant outflow of foreign capital from Indian equities. Now, a double whammy for the rupee as global and domestic factors keep piling up. Remember, this also comes at a time when the RBI has been intervening by selling US dollars in the open market operations, bringing India's forex reserves down to under $640 billion. Yuvika, stay with us, but we also have Mohit Gang joining us this morning. Mohit, help us understand this double whammy and its impact on the stock markets. In fact, a triple whammy, one would say. Number one, the weak rupee against a very strong dollar, which is prompting FIIs to pull out, FPIs to pull out and sit on the sidelines of the Indian equity story. At the same time, the rising oil prices, which will obviously cost India dearly when it comes to its oil import. How do you see all of this panning out, A, for the macroeconomy and B, for the markets?
Morning, Kartik, and it's good to be speaking again. Thank you very much. Look, my sense is this obviously isn't shaping up well for India, particularly. Dollar strengthening, and I think dollar strengthening like anything, it's been a crazy rise. The dollar index is almost at around 110 mark. And along with that, I think, look, what is plaguing us is that we have been pretty late on the curve to reduce rates. That's my sense, and now it's a double whammy. It's a tricky scenario whether we go for a rate cut or not because of the rupee depreciation which we have seen. I think it's happened too soon, too fast, right? And my expectation is that we should see a little bit of a pause here or a breather. I think the realistic level for the dollar index should be around 106 odd or 107 odd. Maybe if things settle down post the Trump era, and I think it's more to do with the Trump era just about to begin, that the markets are pricing in a lot of things right now, and I would assume that the nerves should settle in within next 10 to 15 days once the new regime takes over. And even the new sanctions which have been levied on Russian oil per se, I think that doesn't augur well for India. But my sense is it might just be a bargaining chip for the Trump era to come in and try and curb the war from Russia-Ukraine perspective. So, putting all in perspective, my sense is oil at around $80 is not great for India, but my sense is we have kind of topped out on that for the time being. I think markets is factoring in a lot out there in terms of Russian sanctions coming in and all those things, but that could be a pretty much a bargaining chip. And even in terms of the currency depreciation which we have seen of late, it was long overdue given the kind of depreciation which we saw across the world for other currencies, and rupee was holding steadfast for last 1 or 2 years, and in last 6 months odd we have seen this slide. My sense is this is also kind of overdone for the time being. Right, I'm not talking long term here. I'm talking a pretty small scenario of around 3 to 6 odd months. Once everything settles down, I think this should take a pause for some time, or perhaps from here on, maybe we see a little bit of oil and currency both kind of helping us up in next 3 to 6 odd months.
All right, stay with me, Mohit. Let me bring back Yuvita Singhal into this discussion. Yuvika, now the RBI has been, of course, on the selling spree of its forex reserves, trying to keep the rupee in some mode of not letting it cross 85. It has, however, crossed 86. But I want to understand, is there a requirement for the RBI to continue its interventions or let the rupee slide to whatever its natural value is?
So I think it's a trade-off, Kartik, honestly speaking. So while RBI wouldn't want the currency to, move in either direction in a very volatile manner. So when it does intervene, it intervenes with the intention that they would want the movement in the rupee to be somewhat curbed, because volatility also hits market participants probably more than what the level of the rupee is. So any unforeseen shocks also are hurting in nature. So I think that is the intention or the view perspective from which we need to view RBI's intervention, that they're not trying to push the currency in a direction opposite to what the market forces are wanting to, but probably kind of curtail the pace at which the speed of the direction in which it's moving. So I think that is the perspective we need to see RBI's intervention from. Having said so, I think the rupee overvaluation does definitely warrant depreciation, largely because we have seen our peers depreciate much more meaningfully in the last 1 year or so, whereas our, the rupee was almost steadfast given RBI's intervention. So I think it's time that we let go to some extent. But again, I think RBI's intervention will be there to probably curb the pace of volatility or to curb the pace of depreciation. But I think the direction is towards a depreciating rupee.